I'm Don Calcagni, Chief Investment Officer at Mercer Advisors. So why are private markets so important to investors? And I would argue that there are fundamentally two primary reasons why private markets are so critical to our clients' portfolios. And the first is that private markets are approximately 5 times larger than the entire size of public markets. When we just look at market capitalization, private credit markets, private equity markets are approximately 5 times larger than the global stock market and global bond markets. So there's a huge diversification opportunity there that most investors, candidly, unfortunately, have not taken advantage of until now. And that diversification exists because investors who allocate to private markets are fundamentally investing in companies that have different drivers of returns. Unlike public markets, where returns are driven mostly by these broad macro factors, in private markets, company returns are driven predominantly by endogenous and idiosyncratic factors that are inherent to those individual companies. It could be the business that they're involved in, it could be the quality of the management team, it could be the private equity owner who is working with that management team to help that business mature and to grow. So that's first and foremost, it's diversification. Secondly, is that allocating to private markets is fundamentally about enhancing long-term expected returns in our portfolios. And when we look at the historical data, when we look at venture capital, when we look at private equity, when we look at private credit, those asset classes have significantly outperformed public markets over the past 20 to 30 years. So there is a very strong returns opportunity there that presents itself to investors. Now, why does that higher return exist? Let's be candid. These are illiquid investments. These are private investments. There is no public market for these investments. Often when you are investing in a private credit fund or a private equity fund, you are agreeing to lock up your capital for as long as 10 to 12 years, sometimes longer in the case of venture capital. So we believe that investors are being compensated through what we call an illiquidity premium. And that's why we expect higher expected returns on private markets. In terms of the diversification benefits, another nice benefit of private markets is that they are inherently less volatile than their public market counterparts. Now, that's because these are private investments. They are not marked to market. They do not trade on a public exchange. And in many ways, that also highlights some of the risks that are inherent in these types of vehicles for those investors who perhaps would like to get out before the fund has moved into harvesting mode. Unfortunately, there are no public markets where they can easily sell their interests. Because they are not marked to market, that actually acts as a dampener on portfolio volatility. When everything else in your portfolio is publicly traded and marked to market literally every second, every tick of every day, having something in the portfolio that is only valued perhaps once every quarter, maybe even once every 6 months, that actually helps to reduce the volatility of the portfolio overall. With respect to where the excess returns come from in private markets, we believe that it comes from the fact that in private markets, a private equity investor fundamentally has more control than a manager does in public markets. Most often in private markets, what we find is a private equity manager has a controlling stake in a company. They benefit from information asymmetries. They have access to information that most other investors in public markets just can't or will never have access to. And so they benefit from that information asymmetry. And with that information, because they have control, from there they can actually create more value and extract more value and create more alpha for private equity investors. With respect to private credit, what we find is in private markets, when we are making loans to private companies, we have significantly more control around the terms of the loan. So for example, we can put in place certain debt covenants to protect us as lenders. In the event that there's a problem and the company runs into some financial challenges, we are in a controlling position where we can work with that company to find a path forward to ensure that we are repaid not only our principal, but all of the interest that is due to our investors.